Hey, what's up guys, it's Andrew Kuhn from FocusCompounding.com. In today's video, we're going to be going over 3 metrics that Jeff and myself use to really determine how efficiently companies are utilizing the capital and the equity that investors have invested in the business. When I mean capital, that could be on the debt side, or like I said, that can be on the equity side. But we are going to determine and see just how efficiently they are utilizing it. As you can see right here, and Warren Buffett has said many times that a truly great business must have an enduring moat that protects excellent returns on invested capital. And we actually are going to be going over invested capital in this video. And when he's talking about a moat and protecting invested capital, the logic behind that is because when you have a business that earns exceptional return on invested capital, or capital, return on equity, return on assets, whatever, it's sort of the nature of capitalism that there's always going to be competition that's coming in. So that's why he's always talking about having a moat that's gonna very deep and very wide, that's gonna allow it to protect itself from competition. Because one thing is for sure, that certainly there will be competition. And a good example of that is you can think of Uber, for example. What happened when Uber started becoming successful? Up came Lyft. And you see it every single day in the marketplace. And it's just, capitalism 101, that whenever there's a company that's doing exceptionally well, there will always be competition. So you certainly want a business that has some sort of competitive advantage or moat that's going to protect itself from that competition. And then you can see we put a couple other quotes here. There's another one saying, leaving the question of price aside, the best business to own is one that over an extended period of time can employ large amounts of incremental capital at very high rates of return. And then, of course, Charlie Munger and his quote said, a shareholder of a business that produces 6% returns on capital over time can expect to see investment results much better than 6%. Conversely, a shareholder of a business that makes 18% returns on capital over time will likely see superb investment results that begin to approximate this result over time. What he's saying by that is typically businesses, their intrinsic value will grow at the rate of return that they are growing internally. And we're going to jump right in that. And a couple of key financial metrics, like I said, there's one, return on equity, and I'll show you how this all works out. We're actually going to be going over Amazon and calculating its return on equity, return on assets, its return on invested capital, and then also a different metric that I have been using sort of with Amazon, because I think it's more of an apples-to-apples approach. But as you'll see again, return on assets, and the return on invested capital, return on equity is just, simply put, how efficiently the company is using its shareholders' equity to generate after-tax profits. This doesn't take in the full capital structure because this is not taking in debt. This is just simply taking in equity. Then another metric is return on assets. How well is the company using its assets? But then, the metric that I predominantly use, and every single company is different, but is return on invested capital. And that is how well is the company using all of its capital invested in the business. So that's taking in both the debt capital structure and the equity capital structure, and seeing the returns that the business is earning on the full structure of the business. So we're going to jump right into Excel. We're going to be going over Amazon, and we'll just take it from there. Okay, perfect. So this is Amazon's model that I just inputted all the numbers. I got these numbers from the 10Ks. If you're not familiar with the 10K or how to implement this and sort of go that route, feel free to go back and watch our fundamentals on the SEC.gov website. That will sort of just give you a high-level overview of the 10Ks and different filings and where we got all this information from. As you can see, this is annual 2013 through 2016, and we are going to be calculating the ROE, return on equity, ROA, return on assets, and the return on invested capital. Full disclosure, I'm actually using net income to calculate return on invested capital. Of course, there's many different ways to skin a cat, but typically I either use net income or NOPAT, which is net operating profit after taxes. The way to calculate that would just be taking EBIT, or operating profit, times 1 minus the tax rate, and that will give you NOPAT. Of course, everybody has their own way of doing it, but with Amazon, I am going to be just utilizing net income. And then, of course, like I said, I'm going to be doing a little different way. And this is really, Jeff Bezos always talks about, sort of valuing Amazon using free cash flow. So I'm going to, I have my own little metric, ROF, CF question mark, because it's not really a common metric, but it's really return on free cash flow. So we're going to, see from all the invested capital in the business, how much of that converts to free cash flow. And that's sort of that little metric right there. Again, there's no really hard cold cut way of doing this for every single company, because every company is different. But really, just keeping the big picture in mind, what you're trying to do is really see how efficiently they are utilizing the capital that's in the business and what they're earning on that capital. So we can just jump right in here. As you'll see, I did input all of the numbers from SEC.gov website. I didn't want to do it just for sake of the video during the video, but that is what I did. And you'll see right here, I have a couple margins down there. I am utilizing a Mac, but on Windows for what we're doing right now, the formulas are the same, but we can get right into it. So return on equity, this is 2013. All you really do right here is equals, and then the formula is net income, and then divide that by the total equity that is in the business, which is shareholders' equity right there. And you'll see this is about 3%. Not really a high number per se, but you really do have to take into account that Amazon really is investing a lot in their business for the future. As you can see, they do in 2013, they did $74 billion in sales, which only translated to $274 million in net income. And then you could jump to 2016, they did $135 billion in sales, and they're actually starting to ramp up more, and they did $2 billion net income. But you'll see right here, 3%, typically not too efficient. But if I was sort of normalizing it and really thinking differently, I may have, normalized this technology and content, which is really their R&D. You can sort of break it down and see which is maintenance and which is used for future growth. But that's sort of why Jeff Bezos always says use free cash flow for their real earnings metric. And we'll get in that in the future videos. But for the sake of the video, we'll just get right back to it. ROA, this is just how efficiently they're earning on the total assets that are in the business. And the simple formula for that is actually taking net income again, and this time dividing it into total assets. So that just shows that that's 1%. That's really a low number. Again, for every, let's see, $40 billion in assets, they're really earning 1% on that for return. Not too efficient, but again, this is Amazon, and they totally are investing their, their for their future, and GAAP sort of doesn't reflect their true fundamental value, in my opinion. That's why Jeff Bezos, like I said, always says to use free cash flow. But so to do this, we want to take it across. The good thing about Excel is it's a smart system. It remembers the formula, so all you got to really do is just copy it and go across. And you'll see in 2016 actually started to pick up a little bit. They have 12% return on equity. Not bad. I guess better than average. And the reason for that being is because they did $2 billion in net income. But we'll jump right into return on invested capital. And like I said, the way to think about return on invested capital is really how well is a company using all of the capital that's in the business. So let's take into account, the debt structure, let's take into account the equity structure, and really just showing just the returns that they're earning on it. And, obviously speaking, a business that earns higher returns on capital, higher return on assets, and higher return on equity is better than a business that doesn't. You could think about, someone that has a lemonade stand. Let's say they invested, $5 in lemonade and lemons, and of that $5, they earn, let's say, $10. Well, that business is going to be better than, let's say, company B that owns a lemonade stand that invested $5 and they only earn $2, right? Just keep the big picture in mind. I feel like people really complicate investing. Warren Buffett is right when he says that investing is simple, but it's not easy. And people really do complicate it. Just keep the big picture in mind. Obviously a business that earns higher returns on its capital, is a better business to be in. Okay, so we're going to calculate return on invested capital. The first thing we're going to do, of course, is take net income and drag that across. When you could put it in one cell and then copy it across, which is a good part about Excel. But then we're going to go get the invested capital, the total invested capital in the business. So we're going to go down to the balance sheet. You'll see right here, long-term debt. That's capital that was injected in the business. And then we're going to add that to total shareholders' equity, which is equity, obviously, from the shareholders, to give us a total number of $12,937,000,000 capital that's been injected in Amazon. We're going to drag that across like so, and you'll see that they're really ramping up. And also, a thing to point out is you'll see that as they have ramped up, their numbers, their sales have gone up. Went from 12 billion in invested capital in 2013 to 26 billion in 2016, and now we're doing 2 billion in net income and 274 coming from 274 million in 2013. But then, to come to our conclusion of return on invested capital, we're going to take net income, divide that by invested capital, and that's going to give us our percentage of return on invested capital. And as you'll see, 2%, not too, great. 8%, still not too great in my opinion. I like businesses that, that have higher numbers. But you really have to take into account that, Amazon's GAAP earnings, in my opinion, like I said, they don't really show the true fundamental value of Amazon. Like I said, they're investing a lot for the future, so obviously you're going to see lower returns, which is sort of why I made this ROFCF, return on free cash flow. Like I said, Jeff Bezos is always talking about how free cash flow is sort of better for all companies, for that matter, but especially for Amazon because they are investing a lot in the future. So one way to take this to show how much free cash flow they generate from their invested capital is, again, bring that invested capital down here and then divide it into free cash flow into invested capital, and you'll see that it is a lot more efficient. So I really do think that this is a sort of a more better picture of Amazon and how effectively they're earning on the capital that's in the business. Obviously, like I said, if you are in a business that can grow at high rates of return for a very long time, that is a great business to be in. But anyways, that's all there is for this video. Thank you very much for watching. We'll see you in the next one. Take care.